Good afternoon, everyone. Uh, we're going to wait a few minutes to hopefully get the number of people who signed up for the webinar to get here. So just give me a minute or two before we start. Thank you. Okay, there we go. Good afternoon, everyone, and welcome to today's webinar. This topic being selling a small business and succession planning. Before we go too far, I would like to thank Flagstar Bank for sponsoring this webinar. Flagstar Bank has supported many of our webinars over the years, and we really do appreciate their support. They have provided our chapter in accomplishing our mission, which is a mission of SCORE, is to foster vibrant small business communities through mentoring and education. Uh, Bob, you move it. There we go. Before we get started, also, I'd like to go over a few housekeeping things. Your line is muted. If you can use the Q&A versus the chat, the questions will be answered at the end of the webinar. Also, copies of the slides and recordings will be sent to all attendees. And please complete the brief survey that will be sent to you at the end of the webinar. Appreciate it if you would do that, only because it gives us an idea of what topics we can add or presentations we can put on in the future, which is really what we're trying to do, is satisfy the needs of our business community here in Staten Island. It is my pleasure today also to introduce Mr. Robert Scamardella, a lifelong Islander. Mr. Scamardella began his legal career as an assistant district attorney with Richmond County District Attorney's Office. Since 1982, he has been in private practice and is currently the managing partner of the law firm Scamardella, Gervisi, and Casagrande. With decades of experience as a trial attorney, Mr. Scamardella has expertly handled a wide variety of legal matters, including estate litigation, real estate, and business law. His deep expertise extends to areas such as will probate and administration, business formation and owner agreements, as well as residential and commercial real estate transactions. He also brings a vast knowledge in elder care law and estate tax planning. In addition to his legal practice, Mr. Scamardella is a highly regarded lecturer, providing continued education on commercial and real estate and estate matters. He also is a former adjunct professor of business law at Wagner College, where he shared his invaluable insights with next generation of legal professionals. We are truly honored to have him with us today, and I know you'll find his presentation both informative and engaging. Please join me in welcoming Mr. Robert Scamardella. Okay, then, Mr. Scamardella, it's all yours.
Well, thank you very much, Bart, for that wonderful introduction. And welcome to all of you who have joined us here today. Let's get right into it. The subject today that we're going to handle is called transitioning a business. That is, we have a business that's controlled and owned a certain way, and we're going to transition it to something else. And what are the considerations in such an endeavor, right? Basically, I'm going to approach this by dealing with four main topics. First is the business organization. The transitioning thing, to an extent, is dictated by what type of organization we're dealing with, right? And there's different types, and we'll talk about them basically and see what the differences are between each business organization. And then we'll go into the transitioning aspects, right? The fundamental type would be a business sale, right? You take your business and in return for some consideration, you transfer it to someone else. And then we have this thing called a succession transfer. It's not really an arm's length sale. You take your business and perhaps transition it to a child or children, or maybe even an employee or some such thing. Not an arm's length sale, but a succession plan that's fulfilled. And we'll talk about that. And the third way in which a business is transitioned is through dissolution, right? You just don't put a key in the door and walk away from a business. It has to be formally dissolved. And we'll talk a little bit about why one would do that and what's involved in doing that. If time permits, since we're talking about wrapping up a business, and oftentimes, as we'll see, that's accompanied by retirement, we have some time. We'll talk a little bit about retirement planning, because that oftentimes is what's involved. That is retirement when we're transitioning a business. Okay, so let's start out by talking about the business organization, right? Fundamentally, for our purposes, there are 5 types of organization. Now, if you're in business, you're one of these in all probability, right? You're either a sole proprietorship, a general partnership, a limited partnership, a corporation, or a limited liability company. Now, they're all different, and there are ramifications to the different types. And we'll talk basically about the differences and basically about the ramifications, just to give you some idea of that. Right? Now, what I've done is I put together a chart here that I just want to go through it with you, and I think it'll give you a good handle on the essence of each of the entities. Down the left-hand column, you see we talk about the different entities: sole proprietorship, general, limited liability company, and the corporation. And then across the top are the different aspects of each entity. Formation, what's involved, the existence, how long does this type of entity last, the transferability, is it difficult or easy to transfer, how is it managed, and the last aspect is liability. That is, to what extent are the owners liable for what the legal entity or the business entity does or doesn't do. Right? So let's talk first about the sole proprietorship. Very simple to form. Actually, if you do something for profit by yourself, you are a sole proprietorship, right? You want to go into business washing cars, and you go to different folks' house, you wash their cars, they pay you money. You're a sole proprietorship, right? You didn't have to really do anything. In fact, when it comes to sole proprietorships, there really are no formalities of organization unless you get involved in something that requires licensing, right? Then, of course, you have to get the license, or you want to operate under a trade name. You want to go into business in something other than your own name. Even if it's a sole proprietorship, you got to either get the license or file some paperwork to operate under a trade name. How long does a sole proprietorship last? Well, its existence ends with the death of the owner. What does this mean? This means that if you have a sole proprietorship and you die, whoever is left, it's got a little bit of a problem in terms of either trying to continue the business or sell it. When it comes to the transferability of a sole proprietorship, I talk about it being difficult because you have to actually transfer everything that the sole proprietorship owns. For example, if you have a sole proprietorship and it owns 3 automobiles, well, you got to transfer each of those automobiles, and whatever else it owns has to be transferred. So you may have a series of individual transfers that have to take place to transfer the assets of a sole proprietorship. How's it managed? It's managed by the sole proprietor. Simple enough, right? You go into that car washing business, you manage it. What you say goes. Liability, you're the owner. You're fully liable for everything that business, that sole proprietorship, does or doesn't do. so that while you're washing somebody's car, you do something to the tires, causing the car to crash. Not only will they sue the business, they will also sue you. You would also be liable. I mean, if you take a look at this, the advantages of sole proprietorship, it's easy to form, and it's managed by the owner. Some of the drawbacks to it terminates upon the death of the owner, could be difficult to transfer, and the owner is fully liable for everything that business does. So now we move to a general partnership. It's really a sole proprietorship, but you got two or more people involved, right? So if two people want to go into business washing cars, they just go ahead and do it. No formalities to form it. What are they? They are, in the law, a general partnership. So again, simple to form, but the same things hold true with general partnerships that held with sole proprietorships. That is, if there's licensing required, you got to get it. And if you want to operate under a trade name, there's a little formality there you have to deal with. Its existence terminates upon the death of any one of the owners. What does that mean? That means if you're in a general partnership and your partner dies, you got some problems. That's what it means. Maybe surmountable, but a problem. All right. Transferability, same as a sole proprietorship. You don't have a separate entity owning anything. You got all these separate assets that may have to be transferred. So transferability could be a little bit difficult. Not that it can't be done, but it could be difficult. Management's by the partners. All right. Now I put an asterisk next to that because what happens if the two partners disagree, right? So it becomes a problem. What you have is a deadlocked business that can't do any business, and unless the partners can work it out, the only alternative is dissolution. All right. And from a liability perspective, both partners are fully liable for everything that the partnership does. And one partner is liable for the acts of the other partner. So if you and I go into business, excuse me, washing cars, if you go out and buy $100,000 worth of soap, we're only washing a car a week, and the soap company comes to collect 100,000, and you move to Ecuador, they can come after me for that $100,000. I'm your partner. I'm fully liable for everything that you did, in addition to being fully liable individually to third parties. Again, somebody gets hurt because of something we did or didn't do when we were washing a car, they sue us, we're individually responsible. Very similar to the sole proprietorship. So again, very similar to the sole proprietorship. The advantages are simple to form, all right, and it's managed by the partners. The drawbacks are death of one partner, it has to dissolve, transferability could be difficult, possibility of deadlock if the partners don't agree, partners fully liable. Lot of drawbacks to operating under the general partnership, as you could say. Limited partnership, it's a variation. Limited partnership, you have two tiers of partners. You have something called the general partner, and you have something called limited partners, all right? This you just don't do. This requires a lawyer and formalities of formation, so we put down difficult to form. When does it end? Well, it ends on the death of the general partner. Remember I said there's two types of partner, general and limited. Transferability could be difficult here. You don't really have a separate legal entity. How's management? Management is controlled by the general partner. So I'm the general partner in our car washing business, and I have three limited partners. I manage the business. The limited partners have no say in management. As far as liability is concerned, it's only the general partner who is personally liable for what the partnership does or doesn't do. So if me and three others go into this car washing business, I am liable for what the partnership does. The limited partners are not, although they have no say in management. If you stop and think about it, the only thing the limited partners will be liable for is whatever they put into the business. They cannot be sued for anything above what they put in. So there's some limit of liability for the limited partners, and that's kind of why they have that name. The fourth type of entity is a limited liability company. Now, this is a separate legal entity under law. It gets its own taxpayer ID number. files its own tax returns, etc. Right? Requires a lawyer generally to form it. That's why we put down difficulty. Difficult. There are formalities of formation. Its existence is perpetual. One of the owners or all of the owners die, the entity still exists. There are advantages to that. The transferability of a limited liability can be simple because you can actually issue documents of title, a certificate saying you own 10%, 20%, 30% of this limited liability company. Theoretically, it could be transferred by just endorsing the certificate, giving it to someone else. They pay you whatever money, and you've transferred it. Right? Very similar to a corporation, like we'll see in a second. How's a limited liability company managed? Well, it's flexible. It's managed by something called the members, but who the members are, who the managing members are, is pretty much up to your imagination, right? I mean, you could say that the managing member is the second baseman for the Sunnyside Indians, for the New York Yankees, right? And whoever the second baseman for the Yankees is at that particular point in time becomes the managing member of the limited liability company. The point being, management is flexible, and that could be a way to go for you, depending upon what you want to do from a management perspective. Liability is limited. The owners of the limited liability company have no liability to anybody beyond what they put into the company, right? So if you're looking to limit your liability, good way to go. And lastly, we have the old standby corporation, right? Requires formalities of organization. Therefore, we put down difficult under formation. Existence is perpetual. That's a good thing. Transferability can be simple by the transferring of a stock certificate, even electronically. People do it all the time with companies listed on a stock exchange, right? You can transfer your own ownership relatively simple. How is a corporation managed? Well, there's a legal structure with respect to the management of the corporation that's laid out in the corporation law. The owners are called stockholders, right? They have the right to elect a board of directors who manage the company, right? The overall major decisions of the company. And the board elects officers who control the day-to-day operations of the company. That setup is what you have to have when you have a corporation. You could form a single member or a single person corporation. You could be the stockholder, you could be the sole member of the board, and you could be the sole officer. So one person can operate in a corporate form, just to keep in mind. Lastly, from a liability perspective, the liability of the owners is limited to their investment. They're not personally liable for everything that the corporation does or doesn't do. So if you're, say, a single person, you're going into business, you can keep it simple, be a sole proprietor, but should you die, there's some issues. And if you get sued personally for whatever the business did, you could be liable. Say you opted to be a limited liability or a corporation, you get the benefit of perpetual existence and your liability would be limited. But it's more expensive to form. So there's a yin and a yang for each of these entities, but depending upon which one you're in, the approach or the method to transferring the business or coming up with a succession plan would be different. All right, so we have an idea of the basic businesses that we're dealing with. Let's now delve into the transfer business, right? So basically, the business transfers could either be voluntary, you want to do it, right? Or involuntary, you make a conscious decision to transfer your business. And why would a person voluntarily want to transfer their business, right? So we have down there the first one. It's not doing too well, right? You're having a lack of success, maybe you're losing money, time to do something with this business. Maybe you get a job offer from another company, very attractive offer to do something else. Your business is otherwise somewhat successful, but you can't pass up this offer. So you got to think about transferring your business. Someone comes along and actually offers to buy your business, maybe out of the blue, right? Here we go. We got to transfer it. I just got an offer. The offer's too good to pass up. There's no burnout reason why a lot of people move on. Business is successful. doing okay from a profit perspective, but they're just not enjoying it anymore, just don't want to do it anymore, have things that they always wanted to do in their life, want to go in a different direction. So it's time to transfer the business. You could get sick, right? You're a main cog in your business. You're very active. You're not a passive owner. You get sick or you have health concerns, just can't do it anymore. Time to look into a business transfer. And the last one, you've done it. You've done it a long time. You don't have to do it anymore, but it's successful and it's worth something. You're going to retire. You want to transfer your business. And those are the basic reasons why you would do something like that voluntarily. Now, involuntarily, right? You see the two listed there, incompetence and death, right? You suffer the proverbial stroke. You're out of it. You can't handle anything. It's going to be transferred by someone else. That's the difference between the health concerns above and the incompetence down below. You're out of it. You can't handle it anymore. It's got to be transferred or you die, right? You own a business, you die. That business has got to be transferred. And you have to go down the road of what we're about to talk about. So, voluntary or involuntary reasons why a business would have to be transferred. So let's talk about the types of business transfers that we're gonna delve into. Right? There's something called the arm's length sale. That's what you think it is. You sell your business to someone else. Arm's length meaning it's not between related or known parties. You sell it to an unrelated third party. Then there's the basic succession transfer, right? You transfer the business to somebody who you know, uh, normally know very well, and want them to have your business, right? You could do this. You could provide for a transfer during your lifetime, or on your death. You could say, if you will, or set up that when I die, my business goes to so and so. Right? And these could be gifts, they could be sales, they could be hybrids of the two. So we have an arm's length sale, we have a succession transfer, and the last business transfer is the dissolution. Sort of a misnomer. We're not really transferring it, we're ending it. All right. And that's the dissolution. And we'll talk about business dissolution also. Okay, so let's talk about an arm's length sale, the first one, and some of the basic considerations in that regard. First is to ask yourself or to determine, is the business sellable, right? Some businesses are not, right? Whether or not a business is sellable, you look at various aspects, and we'll talk about that in a second. Assuming we got a business that's sellable, the question is, at what price? Right? How do we determine the price? We'll talk about that. We got a business that's saleable. We've determined our price. What should we do to prepare for the sale? You just don't put a business on the market. Certain things you should do before you place it on the market. We'll talk about that. Your business is saleable. You've determined the price. You prepared for the sale. How do you market a business? How do you sell one of those things? We'll talk about that. Your business is saleable. You've determined the price. You prepared for the sale. You marketed it. You found a buyer. Now you have to negotiate the deal, and we'll talk a bit about that. Okay, so first, is the business saleable? What would anyone or what should anyone look at, right? Kind of obvious. How's it doing from a profit perspective? And what's the history of its profit figures, if you will? Making money just this year, been losing for the last 12, losing money this year, been making money for the last 15. How's the business been doing from a profit perspective and for how long? Then we look at the industry that the business is in. What's with that industry? Right? Is it healthy? Is it growing? Is it shrinking? What's the situation there? Obviously, the healthier and the more attractive or the more expanding an industry is, the better for salability. We also got to look at the condition of the assets and the inventory of the business. business, right? It's got physical assets and even not tangible assets like accounts receivable and the like. How are those assets? What's the status of them? Is it falling apart? Is the inventory old and decrepit, or is it new and fresh, moving relatively quickly? Are the assets in good shape? What are the relationships between the business and its suppliers or vendors? Does it have them? Are they good? Is it sort of seamless moving in? Or the vendors going to be anxious to continue to service the business? And of course, the customer base and the reputation of the business. Right? It's got a broad-based customer base. Only got a few customers. Will they stay? And what's the reputation of the business? And then the health of the balance sheet, very sort of an offshoot of a profit and mounted history, although balance sheet takes into a few other matters. But the bottom line is you're going to want to clean up your balance sheet because any buyer is going to have their accountant or finance person take a look at your books and records. So how healthy they are is a consideration in determining the saleability of a business. And lastly, is the business dependent upon owner personality? In other words, I own a law firm. I'm a sole practitioner. I want to sell my law firm. If I go, will the clients go? If that's the case, obviously not too sellable. If it's the customer base is not too dependent upon the owner or the owner personality, it enhances the saleability. All right, basic checklist in determining the saleability of a business. Now the price, right? Very difficult to value, but believe it or not, there are people who exist who, for a living, value businesses. They exist. They're business appraisers. Depending upon the nature and extent of your business, you may want to retain one of those to come in and value your business for you, so you have an idea of what you can get and or what you should be looking for. That's easy to say. Just going into it a little further, basically, valuing a business, even by the appraisers, is a function of two things. And this is very basic, right? They look at your assets and what the value of them are, and they look at your income, right? Your profit and the history of your profit. And they have formulas for measuring those two things and coming up with values. All right? Where it gets difficult is like an asset would be your goodwill, all right? Your name. How do you value the goodwill of the business? Gets difficult, and why appraisers sometimes are brought in. I have down here the assets are generally, the physical assets are generally easy to value, right? What your autos are worth, your trucks are worth, your inventory is worth, etc. But your goodwill, things along those lines, very, very difficult to value. I would suggest to some business owners in getting an idea of the sellability of your business and the price, just know that what a lot of folks do who are going to invest in a business is they really analyze what kind of income am I going to derive from this business as compared to, alternate investments, particularly passive investments. If I invest my money in the stock market or if I put it into a CD, right? What return am I going to get? If I can put my money into a CD and get a 5% return, I sure as heck I'm not going to buy your business if the profit margin is 5%. It just wouldn't make sense, right? What's the return, the percentage return in your business compared to the basic passive alternate investments would be something to measure in determining the price of your business, right? Bottom line, very difficult to value what it is worth. You got a small business, you can come up with a number that you think you would pay for it, and move on, put it on the market and see what's up. Anything more sophisticated than that, business appraisal would probably be a good idea. Okay, so you determine it's saleable and you've got an idea of the price. You got to prepare for the sale. What should you do? Right? You got to clean up any problems that the business has. Right? To the extent you got debt, you should clean it up, or at the very least, have a plan from the sales proceeds to clear it up. Not too many people want to buy debt. To the extent you got any violations against the business, summonses, things like that, get that all cleaned up. Don't look to sweep it under the rug. The buyer's going to find out about them, and that'll cause problems. You got any pending lawsuits against the business? I try and clean them up before you sell. Going to be difficult to sell with a pending lawsuit or claims. Got outstanding claims against the business. Clean up all of that stuff before you sell. Same thing with your accounts receivable, right? You sell a business and you have accounts receivable 2 years old, 3 years old. That doesn't look good, all right? Nobody's paying this guy. So you want to clean up your accounts receivable, show that they're very collectible. Buyers look into things like this, and it would be good for them to see just that. I talked before about the balance sheet, your financials. The healthier they look, the better you're going to do in a sales situation. And to the extent that you could show that the future prospects of the business are good, do so. Before you put it on the market, think about it, right? Be in a position to articulate what those prospects are. Get your physical assets in good shape, right? It's like you sell a car, right? You wash it, you wax it before you're going to show anybody. They say a good paint job when you're selling a home goes a long way. Well, same thing with selling your business, right? Whatever the physical assets of your business are, crisp it up. Same thing with inventory, right? Got old inventory, get rid of it. Get rid of it. Show up to date, good, clean inventory. I found that if you can get testimonials, even in writing, with the ability to reach out from your customers or your suppliers about, what a good business owner you are and how your customers like doing business there and are loyal to it, and suppliers, same thing, talking about I like doing business with you. You get those things in writing and say, do you mind if I hand these things out? And if a prospective buyer would to contact you, goes a long way. Oh, in terms of valuing the business, just going back to what we said to before, you're obviously going to, or you should, establish a range, right? This is the most I think I would get for my business, and this is the minimum I would take. I don't get this number, I am not going to sell. You also got to think about financing. What portion of the sale are you going to finance as a seller? It is rare. It is rare that a business is sold for what we say all cash. I want to sell my business for $1 million. I want to find a buyer who's going to give me $1 million at closing. Generally, buyers expect the seller to hold a portion of the price. Selling your business for 400, put 300,000 down. You hold a note for 700,000 at 6% a year for 10 years, or whatever. You should give some thought to of your sales price, what percentage of it you're willing to finance, and have in mind what the terms of that financing would be. And the terms really are, the amount of financing, the interest rate, the installment intervals, and security. To what extent do you want collateral for that financing? All right. So establish a range of the value, decide on what you're going to finance, what the terms of that financing would be. You also have to think about confidentiality when you go down this road. That is, you may not want employees to know about this. You may not want to show someone your financials who isn't going to go ahead and buy and disclose that information to who knows who. And there are confidentiality agreements that you could have prospective buyers sign before you turn over certain information to them. But that's a good little checklist of what you should do in preparing for any sale of the business. Now you're marketing your business. You're prepared. Who can I sell this to? Right. Well, generally, you can think about employees. Right. A large percentage of businesses are sold to employees. You have an employee working for you who's been a loyal employee, been there a while. They like the business. Seems they're going to do very well in it. Good place to start. And if you're not on the cusp of selling, right, keep in mind that one of the things you might want to think about as we do all get older, bringing in an employee who may someday be the person who buys it, right? Get a good, loyal employee into the business who takes care of you. Might be a good idea for you to take care of him or her, as he or she may be the person to buy your business down the line. I've seen and had situations where businesses are sold fairly frequently to customers who have a passion for what business you're in. Think about it. Look at your customer base. Might someone there be interested? There may be other businesses who are looking to branch out into what you do. Uh, Good idea to give that some thought. Maybe businesses you could approach. Next would be competitors, right? You're in the same business with someone else, them taking you over, maybe something that would be very attractive to them. So take a look at that potential marketing group. Then lastly is the general marketing, right? As there are business appraisers, there are business brokers out there. You can hire a broker, of course, you'll pay a commission, and the broker will market your business to the general public. So some considerations with respect to marketing your business. Okay, so you've marketed it, and we got a buyer who's very interested. So, what are some of the considerations with respect to negotiating the deal? You should be prepared for some give and take. Right? It's pretty much the case in most deal making. So be ready for it. Take it or leave it approach usually doesn't work by the seller or the buyer. Again, in negotiating the deal, there may be some yin and yang between, and you should expect this, between how much is going to be put down and how much you're going to hold in installments, all right? And whether or not you should be flexible there will depend upon a couple of things, right? And I kind of highlight them in the next bullet point. What are the buyer's qualifications, right? What are we selling it to somebody who can't rub two nickels together? Or are we selling it to someone with financial means? Are we selling it to someone who looks like they have the expertise and the management skills to make a go of this thing? Or do we have a knucklehead on our hands, right? If we have someone without financial wherewithal on their own and someone who doesn't know anything at all about this business, financing a large portion of that deal would probably be a mistake, right? On the other hand, if we have someone very well financially heeled who could bring some security to the table, give you a mortgage to secure the financing on the business, who knows your business very, very well, you might want to think about financing even more of the deal, all right? Be prepared to discuss non-compete agreements, right? Anybody who buys your business is going to want you to be out of that business. You're going to be signing some sort of a piece of paper saying you will not go into that business for a certain period of time over a certain geographic location. No one's going to want to buy your business and have you open up same type of business across the street the next day. So non-compete agreements will be involved in this. And again, there may or may not be some negotiation with respect to the geographical area and the length of the non-compete. Also, as part of these deals, you usually see a requirement by the buyer that the seller remain as an employee for a certain period of time to help with the transition of the customer base, etc. The more you're willing to do that, the more saleable your business will be. So I'm going to sell my business to you. I agree that for 1 year, I'll stay on. I'll work full time. You'll pay me X amount of dollars. Your business, you keep the profit, but you pay me X amount of dollars, and I will manage the business or train you or whatever for a year. And then I may even be agree to be available by phone to answer any questions, etc., for another 6 months after that, or some such variation on that theme. But just know, as part of negotiating the deal, you remaining as an employee may be a negotiating issue. There are a slew of other terms in the sale of a business. How much we put down initially? Are any employees coming with the new buyer? The buyer may say, "I'll buy your business. I'll do this. I'll do that. I'll do this." But I need a 3-year contract from so and so, your employee. I don't want to buy your business, and then your employee's been there 20 years. Says, "No, he or she don't want to work for me. She's going to open up her own business tomorrow." No good, right? You may have existing claims that you didn't clear up. You want the buyer to take them over. That's got to be talked about. Accounts receivable, things to be paid in the future. Who gets them? Do they stay with the seller? Do they go to the buyer? Gee, suppose there's an audit of the business 2 years from now for last year when I owned it. You get stuck with the audit, you being the buyer. How are we going to handle that? Your business has contracts with certain suppliers, etc. Do they have to be cleaned up? Can they be passed on to the buyer, etc.? So there's other contractual terms that could be part of negotiating a deal. How complex they are is directly related to the complexity of the business, all right? But these are some of the main issues that you'll deal with in negotiating the deal. Okay, so that takes care of the arm's length sale and the basic considerations involving an arm's length sale. So now we're going to shift gears and we're going to move to the succession transfer. This is the typical example of which is, a father transfers the business to his son or his daughter, right? Or someone who he knows and he's been involved with for a long period of time, right? So I talked there initially about identifying and training a successor, and the two examples are employee and family members. As I said previously, these transfers can take place while you're alive, or these transfers can take place, upon your death. And we'll talk a little bit about both of those. Now, you want to transfer your business during your lifetime to an employee who's been with you for 30 years or to your two sons, right? You better think about the tax aspects, right? Initially, because there are some, right? You have a certain, I'll give you one, you have a certain basis in that business. That is, what you pay for, what you put into the business is your basis, right? If you sell that business to the extent you realize an amount of money in excess of your basis, that's a gain, and you will pay tax on that gain, all right? Now, interestingly, if you die owning that business and you leave it to, we'll say, your two sons, they do not take your basis. Let's say you own a business and your basis in that business is $300,000. That's what you put into it initially and what you invested over the years. But the business is worth $1 million. You die, your sons inherit the business, their basis becomes $1 million. So basically, if you sold the business the day before you died for $1 million, you'd have a $700,000 gain and have to pay tax on it. If your son sold the business the day after you died for $1 million, they get a step up in basis to the $1 million. They pay no capital gains tax, right? Stop there. You say to yourself, well, heck, why ever transfer the thing during my lifetime? Always better off doing it upon death. Well, not quite. There's this thing called an estate tax, right? When you die, everything that you own is valued Everything is valued, and depending upon the value of it, you have to pay, or your estate has to pay an estate tax. And the estate tax in certain situations may grossly be grossly higher than the capital gains tax that you think you're saving. So there's a yin and a yang there. Point is, there are tax considerations when you're making a lifetime transfer. They should be analyzed. Determination should be made whether a lifetime transfer from a tax perspective is the way to go. It very well may be. It very well may not be. All right. You also have to consider the business transfer to, say, children in the context of your overall estate plan, right? Your business, let's assume your business is worth 80% of your entire estate, right? And you have 5 children and one of them is in the business. Well, if I leave the business to one of my children, he or she gets 80% of everything I own, and my other 4 get 20%. Well, share 20% of everything I own. That may or may not sit well with you, right? And there are ways to coordinate this to make things more equitable, the way you see that equity. Point is, before you go down the road of a succession transfer, you should consider your overall estate plan at the same time. Another consideration with respect to a lifetime transfer is, are you transferring everything? Are you transferring full ownership, management control, full profit-taking ability, or not? All right. There are alternatives here. You could transfer the business, but there are ways to retain management control. You don't get any profit, but you can manage it. You may also want to transfer the business over time, not transfer full ownership of everything in one transaction. Maybe a reason why you want to do this over time, tax and otherwise. So another consideration to be taken into account during a lifetime transfer. You're transferring to maybe 2 sons or 2 daughters, or maybe an employee and a son. You can say, look, I will transfer the business to you for nothing or at a discount, right? But I got to know that you have this agreement amongst yourselves that if you disagree, here's what's going to happen, right? You could require the transferees to have an agreement amongst themselves as to how things would go down if they want to sell the business, if they disagree, etc. Don't have to, stick your fingers in that pie, but as a condition to the transfer, you could. And of course, you structure your payout as part of a lifetime transfer. Could be a full gift, right? I'm gifting to my son. Here, the business is yours, right? You got gift tax considerations, income tax considerations, etc. But you gift it. He or she pays nothing. You could make it a part sale and a part gift, right? And you could say that the business is worth $1 million. I'm gifting 500,000 to you, but you'll pay me 500,000 with 4% interest at X amount of dollars a month for blank years, right? And any variation of that thing can make the whole thing an installment sale. My son's got no money. How's he going to buy my business, right? Well, you're drawing profit, give it to him or sell it to him, full installment sale, right? I don't have to give you anything, but he's got to pay $1 million with, let's talk about the interest, over a period of time. Structure the payments such that the business can more than afford it. Son gets control of the business. He owns it. Where it goes from here is his. You get paid a specific number for a specific period of time. All sorts of variations on that theme. Another one is that you could gift it and get money back by staying there as an employee, right? I'm going to gift it to you. Here it's yours, but I want this employment contract. You will employ me. I will do X. You'll pay me X amount for 2 years, 3 years, whatever. All sorts of ways of structuring your payout if you want one, all right? Major considerations when embarking upon a succession lifetime transfer. Now let's talk a bit about the death transfer, right? Again, same situation to an employee or to children. generally. I'm going to talk a little bit about uh, estates here, but obviously this is not a seminar on estates, but just the basics of it because it's relevant to anyone who's thinking about transferring their business upon their death. Fundamentally, you can transfer it upon your death in one of two ways. You do it by a will, right? Most people have an idea of what that is. It's a written document by which, upon your death, you could transfer your property. You can also do it by this thing called the revocable trust, which you may have heard about, which is a way of avoiding the quote probate of a will. It's a good thing in many situations, not the be all and the end all, not always necessarily required. But the point is, through a written trust or will, you can transfer your business upon your death to whoever you want. Again, you have to consider the taxes. Primarily here, it's going to be the same. If I wait until I die, what's this business going to be worth? What kind of estate taxes is my estate going to have to pay? And what's the offset in the step up in basis that my beneficiaries get? And depending upon that analysis, you may be advised to don't wait until you die. You may be better off doing something from a tax perspective while you're alive. And I'm going to note parenthetically that I've had clients who we've sat down and they know clearly from a tax perspective, they're better off making some lifetime transfers of interest in your business, right? And they say, I got it. I understand. Thank you very much. But no, thank you. Keeping this till I die, that's what I want. I don't want to relinquish one iota of control of anything during my lifetime. And if that means my children got to pay more in tax when I'm dead, so be it. And that's an individual decision. But it's just good to go into those things with your eyes open, have the analysis conducted, and know what the tax considerations are. And again, very similar to lifetime transfer, even in a death transfer, you got to coordinate the transfer of a business with your overall estate plan for the reasons I talked to before. That is, how do you want to treat all your children? And by leaving the business to one, does that create an inequity that you should be dealing with? And of course, whether it does create an inequity that you should be dealing with is entirely up to you, right? It's what you want. All right, so that brings us to the end of the succession transfer and the major considerations there. Hopefully, so far, you have a much better idea. If I want to sell my business, what else? What are the things that I should be thinking about? And if I want to transfer my business to my children, say, during my lifetime or upon my death, what are some of the major things that I should be thinking about? Move on now. To dissolution, right? You're not selling it. You're not embarking upon a succession plan. You gotta close it, right? We're going to talk about what are the reasons why someone would close a business, shut it down, and what is involved in that procedure, the basics of it. And you probably got an idea of the answer to the reasons why a person would close a business. There's low or non-existent profitability, right? Business is losing money. I'm not going to break my you know what day in and day out, week in and week out, year in and year out. I'm not making any money. So time to close this thing down, right? You're making money, but the business is in decline. The future's not good. Maybe it's because of the industry, and it's obviously a bad investment for anyone. And it's not really sellable on the market. I could ride it out a little bit longer and then close it down. The other reason is sometimes these businesses are just too personality dependent. Without you, there is no business. You have no desire to sell and stay in under an employment agreement to manage for 1, 2, or 3 years what somebody's asking for in the hopes that they can transition some clients with you staying there for a while. Too personality dependent. I'm going to close it down. generally the three reasons why that someone closes a business. Okay, so what does closing a business mean? It doesn't mean putting a key in the door. Obviously, they have assets that it should liquidate and sell, which would mean that even in dissolution, there's money on the table, right? I sell my physical assets. I collect my remaining accounts receivable, etc. Again, which would, in most cases, put some money on the table during the dissolution process. To the extent you got licenses and permits, you should go ahead and make sure those are canceled. Leaving those things open could cause problems down the line. To the extent that you have debts, you should resolve them one way or the other. If you have a corporation or a limited liability company where there's no liability on the part of the owner, resolving those debts may become a lot easier than if you were a general partnership or a sole proprietor. But you should give some thought to the debt situation and go from there. I mean, if you have assets, difficult to walk away from your debts. You may want to apply, you may want to negotiate your debts down, pay them off from whatever you realize on liquidation of your assets, whatever the balance is, close it down, keep the money and go home. Again, you should make sure that you've collected your accounts receivable or a mechanism in place to collect them before you dissolve. And there is a certain legal an accounting or tax filing procedure you got to go through to formally dissolve, and you should do it the right way. Not a particularly expensive proposition, but if you dissolve it the right way, it's over, it's done. You don't get letters from the government and the tax department, and who knows who after you've closed down. And it's a good idea to maintain business records. I think you know this for at least 7 years after you've closed the business down. Okay, I got 3 minutes. So I'll talk about retirement planning, which could be a seminar in and of itself, to say the least. The reason why we sort of throw it in here when we talk about resolution of the business is because oftentimes the transition of a business takes place in conjunction with retirement. So it's a good idea, particularly if you're early on in the process, you're a younger person, to plan for your retirement. Trust me, the years come up on you much quicker than you think they are gonna. So we'll talk about what are the advantages of having a formal retirement plan and some of the very, very basic plan types. And you may know this, but I don't want to be too presumptuous. A formal retirement plan is from an accumulation of wealth standpoint, a beautiful thing. All right. I get it. You're young, you need money. It's difficult to take money that you can otherwise put to your child's education, go out and buy a car, go on vacation, etc., and put it somewhere where there's a penalty if you touch it. But what you have to understand is that by doing so, you're embarking upon an extraordinary wealth accumulation method, because if you take this money and use it to go buy a car or go on vacation, you'll pay tax on it. So you have $10,000 coming. You could use it to go on vacation, but probably something like, at least I would say 40% of it is going to go on taxes. So you really only got $6,000 to spend on your vacation, right? What you can do is say, no, I'm not taking it, and I'm going to put it in my IRA, or I'm going to save it for retirement. Now that $10,000 does not become taxable, and you have $10,000 in an IRA vehicle, maybe in the stock market, accumulating income. So you got $10,000 working for you over a long period of time, whereas if you spend it on the vacation, you got a $6,000 vacation and it's gone.
Only
So
in California.
the more you put into this wealth accumulation thing, the more you're going to accumulate, And when it comes time to retirement, be very glad you did. All right. Another good aspect of retirement plans are any contributions you make to a retirement plan are tax deductible to the employer. They're only taxable to the recipient when they're withdrawn, generally when recipients in a lower tax bracket. And again, the interest and growth on that investment are tax deferred. Don't pay tax not only on what you initially put in, but on what it grows until you take it out when you retire. Great way to fund a retirement, right? Again, the trade off is you give up the ability to spend that money now. Uh, Okay, I think we're just about done here. Types of plans, just quickly say it. They're all types. There's a simplified employee pension plan, a SEP, SEP, very, very, very easy to set up. You can have plans where the employer matches what the employee is putting in, up to limits to encourage employees to do it. We have what are called defined contribution plans, where the employer agrees to contribute a certain amount to a plan every year. That's pretty much what a 401k is to an extent, but there the employee has some say in it. You have profit sharing plans where you could lay out if the business has this much profit, that's what will be contributed to the plan. And lastly, there's this defined benefit plan. You don't see too much of that. That's where the employee is guaranteed a certain benefit when he or she retires. Now, you may be looking at these things, last point, you may be looking at these things and say, well, wait a minute, I'm going to create a defined benefit plan, a defined contributions plan for my employees. I can't necessarily afford that. Well, you may have one or two employees, one of which is you, right? So by creating these plans for you and your employees, you're not only keeping employees happy, right? You're not only making working for you more attractive, you're also planning for your own retirement. So talking to a retirement expert, if you're early on in the game, is a very, very advisable thing for a business person to do. So that's it in terms of the overview of the transitioning of a business. I think Bart would accept some questions. We have a few minutes for some questions.
Right, we have two questions, Bob. The first one I'll just answer. Are there any handouts for this webinar? Yes, all the participants who attended this webinar will both get a copy of the recording and also a copy of Bob's slide presentation. And that's that one. And the other question is, can life insurance be used in succession planning, Bob?
Yeah, sure it could. It can be used in two ways, right? There's two aspects of life insurance that could make it a money source, all right? Obviously, one is the death benefit, right? You get some life insurance and you die, you know that money falls out of the sky when you die, right? And you can direct how that money goes. For example, I spoke before about if part of a succession plan, you're leaving your business to one son, but you have four others, right? And he's getting 80% of everything. How can I deal with this? Well, we can go out and get some insurance, right? And name the four other sons as beneficiaries of that insurance to sort of even things out. A very basic example of how life insurance death benefit could be used in a succession plan. The other aspect of whole life insurance is there's a cash value to insurance as you pay premiums on that insurance. If it's a whole life, that is not a term policy, there's a cash value in that policy, right? If you cancel it while you're alive, you get some money back, the cash value of it, right? You can borrow against that. That could provide monies to facilitate a succession plan. So yeah, there are ways in which life insurance can be used to facilitate a succession plan because at the end of the day, particularly whole life insurance policy is a revenue source.
Very good, Bob. Well, that's it, Bob. And first of all, I'd
Good.
like to thank you for the great presentation. I'm sure everyone had enjoyed it. I have enjoyed it. And so with that, is there's that's it, and we'll call it a day. Thank you
Very
again,
good.
Bob. Really do
Very,
appreciate it.
very good, bud. You're very welcome. Take
Take
care.
care.